The false calm of crude oil between OPEC and the Fed.
Monday's session confirmed what the oil market had been hinting at for days. The current price consolidation is not stability but rather pent-up tension. After weeks of extreme volatility, Brent and WTI retreated slightly, down 1.5% and 1.33% respectively, in response to an ambiguous signal from OPEC, the possibility of a production increase in December by 8 member countries. On the surface, the move aims to regain market share lost to Russian and US crude. In practice, it opens a new front in the silent war for global energy influence. The Saudi decision to allow this move confirms that the cartel prioritizes political power over price stability. Meanwhile, the Federal Reserve and its imminent rate decision act as another latent trigger. Energy markets carefully interpret every subtle nuance and signal from Jerome Powell as a reliable forecast of future demand. An aggressive rate hike, growth, and with it, a noticeable increase in overall fuel consumption. A pause, on the other hand, could potentially spark a brief but notable short-term technical rally in the market.
The technical landscape, fragile supports and heavy resistances.
In WTI, the structural support at $56 keeps the market alive, but the resistance between $62 and $65, where the 50 and 200 SMAs converge, is becoming a psychological barrier. A clear breakout above $66 would open the way to $70, but as long as the price remains below that level, the bias remains bearish. The RSI is recovering some ground, yes, although at the moment it lacks fuel as Lopez's supply is draining it. In natural gas, the expanding rising wedge pattern reflects the market's schizophrenia, volatility without direction. The supports at $2.50 and $2.60 continue to defend the long-term trend, but only a sustained break above $3.90 would validate a new bullish cycle towards $5.
The dollar and risk perception.
The DXY index is consolidating between 96.5 and 100.5, waiting for the Fed's signal. Each additional point of the dollar acts like a stone on the barrel, making raw materials more expensive and limiting the appetite of speculative funds. Altogether, this triangulation, expansive OPEC, indecisive Fed, and pressured dollar, produces a neutralizing effect. No player manages to impose a trend. This is the typical prelude to a sharp move.
Conclusion. Artificial calm before the storm.
The conclusion. The oil market is not stable. It is suppressing energy potential. OPEC Plus is playing the impossible balancing act between discipline and expansion. The Fed is engaged in monetary tightrope walking, and traders are forced into patience. When any of them breaks out of their consolidation pattern, whether through an unexpected rate decision or a production cut by a major company, we will see a significant move. Until then, Brent will continue to fluctuate between $61 and $65 with a technical ceiling and a political floor. The real question is not when oil will rise, but who will give in first, OPEC. Hello, Faye.